Today I'm reviewing A Random Walk Down Wall Street. Is this an enjoyable finance book? Well, that's not possible. This is considered an absolute classic of investing. I'll give you some brief thoughts about the book and then I'm going to go into detail on some of the contents. Brace yourselves! And the absolute first thing to say about this is it's incredibly readable. Malkiel's writing style is fantastic and his storytelling makes this a really engaging read. Some people disagree with his ideas, but you can't deny that they're presented very well. It's a great overview of all sorts of investment strategies. Some finance books feel like getting hit in the face with a calculator. That is surprisingly accurate. Just a bit about the author. The author is Burton Malkiel. He is 93. This is actually a signed copy. This is not my copy. This is my wife's uncle's copy. I've had it for about 2 years. I need to give it back when we visit over Christmas. Anyway, Burton Malkiel has been a professor of economics at Princeton and also held roles like the Dean of the Yale School of Management. So unlike most people giving stock tips online then. The first edition of this came out in 1973 and he's kept updating it with subsequent editions. The 50th edition came out in 2023 with yet more updates. This edition I read was from 2016, so at this point in time it says there were 1.5 million copies sold. I think now it's up to over 2 million copies of this book have been sold. And the title comes from the idea that you'd have just as much luck picking stocks by throwing darts at a dartboard instead of following some professional stock analyst. I love darts. So there's that concept, and the other major framing device is, do you pick stocks based on the firm foundation theory or the castles in the air theory? Firm foundation for me. In the firm foundation theory, you're picking the stocks based on the fundamentals, like do they have a profit? What is the performance? What's the value of this stock? And on the other hand, the castles in the air theory is basically a beauty contest. It's saying, okay, what do I think the market as a whole is going to pick? What is going to be the stock that everyone goes for? And then I want to sell before everyone else does. Funnily enough, Malkiel then goes on to show that academic studies have found that neither of those theories actually guarantee results. And the reason for that is basically the efficient market hypothesis, that any public information about the company is already baked into the stock price, and it's basically random chance as to whether the stock will go up or down. A good analogy for this is if there's $100 lying around on the ground, it's not going to stay there for very long. Any sort of public information about the company that would influence its price will be taken advantage of very quickly. So what do? Well, you follow modern portfolio theory, which basically spreads risk by buying things that don't move together, i.e. things with negative correlations. Like if it's sunny, this stock is going to go up. If it's rainy, it goes down. But in this stock, well, they sell umbrellas. So when it rains, that stock's going to go up. And so you hedge your bets by buying both. I'd buy the rain one. I trust rain always shows up. But then how do you beat the market? Well, you take on more risk. But measuring risk is hard. And there's this whole thing about smart beta, and that's how you measure the risk, and I'm not going to go into any of that. I measure risk by how loudly the dog barks behind the gate. And again, academic studies have shown that the results for that aren't all that great either. He then goes on to talk about behavioral finance, and this is probably the most interesting part of the book actually. It posits the fact that the market is not efficient because people are irrational. They're not rational creatures. And then he goes through a bunch of things about how people are not rational. One is overconfidence. Everyone thinks they're above average. The optimism bias. People are optimistic about future outcomes. Just look at people's TBRs for 2026. He also mentions biased judgments, how we are not free of bias. I'm not biased. Another thing is herd mentality. And this is one I will go into. There's this classic line experiment called the Ash conformity experiment. And the test subject is put in a room with 7 other people. Then they are shown some lines. There are 3 lines, A, B, and C, and they all have different lengths. And then there's another line which matches one of those 3. And they're asked to say which of the 3 it matches. Does it match A, B, or C? And it's like really obvious which one it matches. Now here's the catch. the other people in the room are actually actors. And so for the first 2 rounds, they give the correct answer. But then from then on, they always give one of the wrong answers. And so they're seeing if the test subject is going to go along with everyone else, because they are the last in the line of participants. So they've been given, yes, this is C, even though it's the wrong answer. Everyone has said C. Does the test subject say C or the correct answer? And in like a third of the cases, they give the wrong answer. They go along with the herd. And at the end of the experiment, the test subject is queried about why they chose the way that they did. And there's all sorts of reasons, but in a lot of reasons, they actually knew the correct answer. They just decided to go along with the herd. And that just exhibits itself everywhere in the world. In terms of BookTube, there are books that people are like, yes, this is the best book ever, and everyone else seems to go along with that. And then you read it and you go, is it? Really? And another interesting wrinkle in that is they changed the experiment and had an ally. So one of the actors would actually give the correct answer. And in those cases, overwhelmingly, the test subject would also give the correct answer. So it only took one ally in order for that person to have the courage to give the correct answer. And then lastly, he also talks about loss aversion, that people are 2.5 times more likely to put effort into averting a loss rather than focusing on a gain. That the amount of negative feelings versus the positive feelings for this loss here, you have to have 2.5 times as much positive gain in order to have the same kind of feeling of emotion. And so taking all that together, the behavioral finance guys basically say, well, there's an arbitrage that can happen here, because people are irrational. Really, the stock price should be here. People are irrational, so it's here. And therefore, you can do things like shorting the stock, because it shouldn't be up here. It should be down here. I'm going to sell at this price because I know fundamentally the stock price should eventually come down to this price, and then buy there, if you know what shorting the stock means, or vice versa. But of course, short selling isn't always possible. And so he has some advice about that. Basically, avoid the herd, avoid overtrading, sell losers, not winners, even though that's painful, and avoid hot tips. The next part of the book is very US focused. It's kind of related to specific investments in the US and state taxes and federal taxes and how all that relates. Useful if you're American. America! And then he talks about an investment strategy based on different times of your life and looking at PE ratios and the average returns over the last 80 years. And it all boils down to this. Basically, invest in a low-cost index fund. And people are still going to make terrible choices. Yep, and if you want to play the market, do it with a small portion of your funds. Look for stocks that have good earnings over the last 5 years, that have reasonable PE ratios, and some sort of castle in the air appeal. You know, things like Apple and Nvidia. And trade as little as possible to minimize the fees. And there's also an appendix on derivatives. And he does admit, yes, there is potential to beat the market if you are someone like Warren Buffett. You are not Warren Buffett. I'm definitely not. So for most people, I think Burton Malkiel's advice is pretty sound. There's a reason this is a bestseller. It's absolutely worth reading. Yep, it's pretty good.